Cash is disappearing, not by accident, but by design, and what's replacing it isn't money in any meaningful sense of the word. It's programmable surveillance wrapped in the convenience of tap-to-pay, promising efficiency while delivering total financial control to governments and corporations who will know every dollar you earn, every purchase you make, every transaction you attempt, and will have the power to approve, deny, tax, or confiscate at will without warrants, without appeals, and without you even knowing it happened until your transaction is declined and you discover that your money, which you worked for and thought you owned, isn't really yours at all, but is digital entries in a database controlled by institutions that can freeze, seize, or limit your access whenever their algorithms decide you're a risk or whenever political winds shift against behaviors they want to discourage. As of 2025, 134 countries representing 98% of global GDP are actively researching, developing, or piloting central bank digital currencies, with 4 nations already having fully launched retail CBDCs and major economies like China, India, and the European Union running large-scale pilots. This isn't distant speculation. It's happening now, being built systematically while being sold as modernization, financial inclusion, and protection against crime, the same justifications governments always use when expanding surveillance and control. Understanding how digital money will trap the middle class means recognizing that when every transaction is digital, monitored, and controllable, you lose the last vestige of financial privacy and autonomy that physical cash provided, the ability to transact privately without permission, to save without surveillance, to spend without someone tracking what you buy, and to exist economically without complete dependence on systems that can exclude you instantly if you fall out of favor with authorities or algorithms. The trap is being constructed systematically through convenient payment apps, through the elimination of cash acceptance at businesses, through CBDC development that will replace private digital currencies with government-controlled ones, and through regulatory frameworks that criminalize alternatives like cryptocurrency that might preserve some autonomy. And once the trap closes, once cash is effectively eliminated and all transactions flow through monitored digital channels, the middle class will discover they never owned their money at all. They were just allowed to use it temporarily at the pleasure of systems that can revoke that permission without explanation, without recourse, and without caring that financial exclusion in a cashless society means exclusion from economic life entirely. Congress 1. The mechanics of how digital money enables unprecedented control start with the basic architecture of CBDCs versus cash. Physical cash is bearer currency, meaning whoever holds it owns it and can transfer it to anyone. Else, without intermediaries' permission or record, if you have a $20 bill, you can hand it to someone in exchange for goods without anyone else being involved, without any record of the transaction existing, and without any ability for third parties to prevent or reverse the transaction. This peer-to-peer anonymous final settlement is what makes cash money in the traditional sense. CBDCs are fundamentally different. They're digital tokens in a centralized database controlled by the central bank, with every transaction recorded, monitored, and requiring permission from the system to execute. When you spend a CBDC, you're not transferring anything physical or even digital in the way cryptocurrency transfers occur peer-to-peer. You're requesting that the central bank update its database to decrease your balance and increase the recipient's balance. That request can be approved, denied, delayed, taxed, or reversed by the controlling authority. You don't own the money. You have permission to access database entries that represent money, permission that can be revoked. MF+1. China's digital Yuan, the ECNY, demonstrates the control architecture perfectly because China isn't hiding what they're building. The system has been in large-scale pilot since 2017 and now processes hundreds of millions of dollars in transactions. The People's Bank of China maintains complete records of every transaction, knowing who spends, what is being spent on, and where it is spent. They can immediately freeze questionable assets or accounts. This isn't a bug or an unintended consequence. It's the explicit design purpose. The Chinese government calls it controlled anonymity, which is Orwellian doublespeak, meaning the central bank knows everything but claims to limit how that information is used. CoinLedger. The stated justification is combating illegal activities, including money laundering, terrorist financing, and tax evasion. But the definition of illegal or questionable is whatever the government decides, which in China means political dissent, religious practice the party disapproves of, or simply behaviors that conflict with social credit scores or other surveillance systems. The digital yuan gives the Communist Party complete visibility into every citizen's financial life and the ability to punish disfavored behavior by freezing accounts, limiting transaction types, or making certain purchases impossible. China Center. The metadata captured goes far beyond basic transaction details. The system can collect information about users' movements through location data from their devices, spending patterns that reveal their habits and preferences, connections to other users showing their social networks, and various metadata associated with users' movements and devices that gets integrated with China's broader surveillance infrastructure. This creates a comprehensive financial profile of every person in the system, making financial privacy impossible, and allowing the state to predict, influence, and control behavior through the lever of money access. China Center, Western governments and central banks insist their CBDC designs won't replicate China's surveillance, claiming they'll protect privacy and limit government access to transaction data. But the technical architecture of CBDCs necessarily creates surveillance capability that didn't exist with cash, and once that capability exists, the temptation and pressure to use it for law enforcement, tax collection, and eventually behavior control becomes irresistible. The European Central Bank's recent statement that if central banks don't issue digital money, they will lose their central role in money issuance reveals the real motivation: maintaining control. CBDCs aren't about improving money, they're about preventing alternatives like cryptocurrency from replacing government-issued money and thereby reducing government control over the population. ECB.Europa. The privacy loss in a cashless society extends beyond CBDCs to all digital payment systems. Credit cards, debit cards, PayPal, Venmo, Apple Pay, and every other electronic payment method creates permanent records of every transaction that are accessible to financial institutions, payment processors, government agencies through subpoena or surveillance programs, and potentially to hackers who breach databases. Unlike cash transactions, which leave no trace, digital transactions create a traceable electronic footprint, making it difficult for individuals to maintain privacy. Lexa+1. This comprehensive transaction surveillance allows profiling that reveals intimate details of your life. Your purchases show your health conditions through pharmacy transactions, your political affiliations through donations, your religious practices through charitable contributions, your relationships through gift purchases and shared expenses, your habits and preferences through every item bought, and your movements through location-tagged transactions. This data is tracked by consumer spending habits and can be shared or sold to advertisers, data brokers, and government agencies. Your financial life becomes a commodity bought and sold by institutions you never agreed to share with. Flexa. The cybersecurity risks compound these privacy concerns. Centralized databases holding financial information are high-value targets for cybercriminals, increasing the likelihood of data breaches and identity theft. When your entire financial life exists as digital records and databases, those databases become targets for hackers, foreign intelligence services, and criminal organizations. A breach exposes not just your current balance, but your complete transaction history, creating permanent vulnerability to identity theft, blackmail, and fraud. Cash, by contrast, exists physically and can't be hacked or stolen through database breaches. Flexa. The financial control enabled by digital money goes far beyond surveillance to include programmable restrictions on how you can use your money. CBDCs can be designed to limit what you can purchase, where you can spend, and when transactions are allowed. This programmable money capability allows governments to implement policy through the currency itself rather than through laws and enforcement. Some hypothetical but technically feasible examples illustrate the danger. IMF want to discourage carbon emissions? Program CBDCs so that purchasing gasoline or airline tickets costs a surcharge, or limit how much fuel each person can buy monthly. Want to control diet? Restrict CBDC spending on alcohol, tobacco, sugary foods, or other unhealthy items beyond certain amounts. Want to prevent capital flight? Program CBDCs so they can't be converted to foreign currency or spent internationally without approval. Want to enforce sanctions or embargoes? Make it impossible to send CBDCs to disfavored individuals, countries, or organizations by programming the currency to reject those transactions. Want to stimulate spending? Give CBDCs expiration dates so money not spent within a certain period disappears, forcing constant consumption. These capabilities don't require new laws or enforcement. They're executed automatically by the currency itself through code. If the central bank wants to prevent you from buying something, your transaction is simply declined. There's no hearing, no appeal, no ability to circumvent it by using cash because cash doesn't exist anymore. The money itself becomes a tool of social control that operates invisibly and automatically, embedding policy preferences and political priorities into the medium of exchange. China's social credit system demonstrates how programmable money integrates with broader surveillance and control systems. Citizens receive scores based on behaviors the government monitors: financial responsibility, criminal records, social media posts, personal relationships, and compliance with laws and regulations. Low social credit scores result in restrictions including the inability to buy airplane or high-speed train tickets, restrictions on buying property, exclusion from certain jobs, lower internet speeds, and restrictions on where your children can attend school. Integrating this system with a digital currency makes the restrictions automatic and total. Someone with a low social credit score might find their digital yuan simply won't work for disfavored purchases, won't convert to foreign currency, or has reduced purchasing power through automatic taxation on transactions. Western governments claim they won't implement systems like China's social credit, but the infrastructure for similar control is being built through CBDC development, digital identity systems being implemented globally, know your customer regulations requiring financial institutions to collect comprehensive information about customers, and anti-money laundering rules that flag suspicious transactions for investigation. Once the infrastructure exists, using it for broader control becomes a matter of political will rather than technical capability. And history suggests that surveillance and control capabilities, once created, inevitably expand beyond their original stated purposes. The financial exclusion risk is perhaps the most dangerous aspect of digital money systems. In a cash society, even someone completely excluded from the banking system can participate in the economy by using physical currency. Someone with no bank account, bad credit, or who's been blacklisted by financial institutions can still work for cash, buy goods and services with cash, and save cash under a mattress. It's not optimal, but economic participation remains possible. In a cashless society where all transactions are digital and require approval from financial institutions or the central bank, exclusion from the system means exclusion from economic life entirely. Flexa. This creates enormous power over individuals who can be excluded for reasons ranging from legitimate concerns about crime to political persecution to algorithmic errors. Someone flagged by anti-money laundering systems, even incorrectly, might find their accounts frozen and their ability to transact eliminated. Someone who protests government policies might be excluded as a political dissident. Someone who falls behind on debt payments or has a judgment against them might have their CBDC access restricted. Someone whose social media posts are deemed problematic might find themselves unable to transact. And someone who's simply flagged by a malfunctioning algorithm might discover they can't buy food, pay rent, or survive economically until the error is corrected, a process that could take days, weeks, or months if it happens at all. The Canadian trucker protests in 2022 demonstrated this power when the government invoked emergency powers to freeze the bank accounts of protesters and those who donated to them, cutting off their financial access without trial or conviction. This was done through existing banking systems and required government orders. With CBDCs, such financial censorship could be executed instantly by the central bank without requiring cooperation from private banks and without creating the public paper trail that legal orders generate. The protester simply finds their money won't work, with no explanation and no recourse. The taxation implications of digital money are profound and disturbing. When governments have complete visibility into every transaction and the technical ability to automatically deduct taxes in real time, tax policy can become far more aggressive and comprehensive. Rather than filing annual returns based on reported income, the government could simply take taxes automatically as transactions occur. Every time you're paid, taxes are withheld instantly. Every time you sell something, capital gains taxes are deducted automatically. Every transaction could include sales taxes, wealth taxes, carbon taxes, or any other levy the government decides to impose, all collected automatically through the digital currency system. MF. This removes the friction and visibility that current taxation has. When taxes are withheld from paychecks or paid quarterly or annually, people see what they're paying and can push back politically if they feel overtaxed. When every transaction includes automatic taxation that happens invisibly in fractions of a second, people lose awareness of the total tax burden and government faces less political resistance to increasing rates. The ability to implement real-time taxation through programmable currency also allows governments to fine-tune tax policy to influence behavior, charging different rates for different purchases or for different people based on their income, location, or other factors. The financial repression capabilities are equally concerning. Governments with unsustainable debts, as discussed in previous scripts, face pressure to reduce the real value of debt through inflation, while preventing citizens from escaping that inflation by converting to foreign currency, gold, or other stores of value. CBDCs make this financial repression much easier to enforce. Capital controls can be embedded in the currency itself, making it technically impossible to convert to other currencies without permission. Negative interest rates, where you pay the government for the privilege of holding money, can be implemented by programming balances to automatically decrease over time, forcing spending and preventing saving. And if government wants to confiscate a portion of everyone's wealth, they can simply program a one-time reduction of all balances, a digital wealth tax that happens instantly and can't be avoided. Cyprus in 2013 provided a preview when the government imposed a bail-in, taking a percentage of bank deposits over certain amounts to recapitalize failing banks. Depositors woke up to find their balances reduced by government order. With CBDCs, such confiscation becomes trivially easy to implement and impossible to evade because you can't withdraw your money or move it before the confiscation occurs. The central bank simply updates the database, reducing everyone's balance, and it's done. Your wealth has been taken without physical seizure, without giving you opportunity to hide it, and with complete precision taking exactly the percentage or amount the government decided to confiscate. The 98% of global GDP now covered by CBDC activity means this isn't a hypothetical distant future. It's being built now across most of the world simultaneously. The International Monetary Fund, Bank for International Settlements, and other international financial institutions are actively coordinating CBDC development across countries, creating interoperability standards so that different nations' CBDCs can interact and transaction surveillance can span borders. This international coordination ensures that escaping one country's CBDC system by moving to another becomes impossible because all systems will share information and enforce each other's restrictions. Bias +2. The specific countries that have fully launched CBDCs as of 2025 are Jamaica with Jamdex, the Bahamas with the Sand Dollar, Zimbabwe with ZG, and Nigeria with the e-Naira. These early implementations provide case studies in how populations react to CBDCs and what problems emerge. Nigeria's e-Naira launch in 2021 has faced resistance, with adoption remaining low despite government pressure because Nigerians understandably prefer payment methods that don't give their government complete visibility into their financial lives. This resistance is why governments are simultaneously eliminating cash rather than just offering CBDCs as alternatives. If people have choices, many will choose privacy over convenience. So governments must eliminate the private alternative to force adoption of the surveillance alternative coin ledger. The elimination of cash is happening through multiple channels simultaneously. Businesses increasingly refuse cash, claiming it's for efficiency or security, but really it's to reduce costs of handling physical currency and to gain the transaction data that digital payments provide. Banks are closing branches and eliminating services for cash transactions, making it increasingly difficult to deposit or withdraw significant amounts of cash. ATMs are being removed from many locations, and regulations are being implemented limiting cash transactions above certain amounts, ostensibly to combat money laundering but really to force transactions into monitored digital channels. The European Union has proposed banning cash transactions above $10,000. Similar limits exist or are proposed in many countries. The cumulative effect is to make cash usage increasingly impractical, forcing even those who prefer cash to shift to digital methods. The generational aspect accelerates this trend. Younger people who've grown up with smartphones and digital payment apps often prefer them to cash for convenience and see no problem with the surveillance implications because they've never known financial privacy and don't miss what they never had. This generational shift makes it easier for governments to eliminate cash because resistance is primarily from older people who remember when cash was normal and who will age out of the population over coming decades. By the time digital natives control policy, privacy in transactions will seem like an archaic concept, like privacy in communications already seems quaint to generations who share everything on social media. The cryptocurrency counter-argument is that Bitcoin and other cryptocurrencies provide an alternative to government-controlled digital money, offering privacy and censorship resistance. But governments are systematically attacking cryptocurrency through regulation, taxation, and eventually likely prohibition of private cryptocurrencies as competition to CBDCs. The SEC and other regulatory agencies worldwide are enforcing regulations that make cryptocurrency usage difficult and expensive. Tax reporting requirements for cryptocurrency transactions are onerous, and banks are increasingly refusing to serve cryptocurrency businesses or individuals with significant cryptocurrency holdings, a form of financial censorship that makes it difficult to convert between cryptocurrency and fiat currency. Once CBDCs are widespread, governments will likely ban private cryptocurrencies entirely as threats to monetary sovereignty and as vehicles for evading taxation and control. China has already banned cryptocurrency trading and mining. Other authoritarian governments have done the same. Democratic governments will follow using justifications about consumer protection, financial stability, and preventing crime, but the real reason will be preventing alternatives to controlled digital money. If cryptocurrencies can provide privacy and censorship resistance, people will use them to escape CBDC surveillance and control, undermining the entire purpose of CBDCs. So cryptocurrencies must be eliminated or regulated into irrelevance to make CBDC systems effective. The class dimension of digital money control is critical. The wealthy will always have options to escape the worst of digital money surveillance and control. They can hold assets internationally in jurisdictions with more privacy. They can use sophisticated financial structures that obscure ownership and control. They can afford lawyers and accountants to navigate regulations and find loopholes. They can maintain access to private banking services that offer confidentiality. And in extremis, they can physically relocate to jurisdictions with better privacy and less financial control. These escape routes won't be perfect or complete, but wealth provides options and flexibility that moderate and low-income people don't have. The middle class, by contrast, will be completely trapped. They can't afford international diversification, sophisticated structures, or relocation. They depend on employment income deposited digitally on mortgages and loans from mainstream financial institutions, on credit cards and payment apps for convenience. They have neither the wealth to escape through the top nor the ability to survive on cash and barter like some very poor populations might. They're completely dependent on the formal financial system, making them completely vulnerable to financial surveillance and control that system enables. When CBDCs become mandatory and cash is eliminated, the middle class will discover they have zero financial privacy, zero ability to transact without permission, and zero recourse if they're excluded from the system for any reason. The political economy of why this is happening despite obvious dangers comes down to government power and institutional interests. Governments want CBDCs because they provide surveillance, tax enforcement, capital control, and policy implementation capabilities that cash doesn't allow. Central banks want CBDCs to maintain their monopoly on money creation and prevent private alternatives like cryptocurrencies or stablecoins from reducing their control. Commercial banks are more ambiguous because CBDCs could disintermediate them, but they're accepting them as inevitable and positioning to profit from providing second-tier services like wallets and payment processing. Technology companies support cashless digital payments because they profit from payment processing and from the data generated. The only groups that lose from eliminating cash and implementing CBDCs are ordinary citizens who value privacy, dissidents who depend on financial access to challenge governments, and anyone who might be excluded from digital systems for any reason. These groups are politically weak compared to governments, central banks, and technology companies pushing digital money. And importantly, the costs of digital money control won't be apparent until it's too late to reverse course. While cash still exists and CBDCs are optional, the system seems benign. Only after cash is eliminated and CBDCs are mandatory will the control become obvious, and by then, there will be no alternative and no escape. The historical parallel is the elimination of gold backing for currency. When dollars were redeemable for gold, government faced constraints on money creation because they needed gold reserves to back the currency. Eliminating gold backing in 1971 allowed unlimited money creation, but removed the constraint that had prevented inflation and currency debasement. Similarly, cash provides a constraint on government financial control because cash transactions are private and unmonitored. Eliminating cash removes that constraint, allowing total financial surveillance and control that wasn't possible when people could transact privately using physical currency. And just as eliminating gold backing led to inflation and currency debasement, eliminating cash will lead to financial repression and control that would be impossible in a cash-based system. The international precedents for how this ends come from countries that already have comprehensive financial surveillance and control. China's social credit system combined with the digital yuan creates Orwellian conditions where citizens know they're being monitored constantly and adjust behavior to avoid penalties. Venezuela's digital currency, the petro, was imposed as the government lost control of its fiat currency to hyperinflation, but has failed to gain adoption because citizens don't trust it and prefer dollars when they can get them. India's attempt to eliminate cash through demonetization in 2016 suddenly invalidating certain currency notes to force digital adoption, caused economic chaos but demonstrated government willingness to force digital transitions even at enormous social cost. These international examples show that government willingness to impose digital financial control is not limited by respect for privacy or freedom, but only by technical capability and political calculation about what they can get away with. As CBDC technology matures and as cash usage declines, making elimination more feasible, governments will move increasingly aggressively to force digital financial systems that maximize their surveillance and control while minimizing citizen privacy and autonomy. The preparation strategies for individuals are limited but important. Use cash as much as possible while it still exists to maintain the infrastructure and social acceptability of cash transactions. Hold some physical precious metals that can't be digitally confiscated or monitored. Maintain some cryptocurrency holdings despite regulatory hostility, preferably privacy-focused currencies like Monero that can't be easily traced. Develop barter networks and direct exchange relationships that don't require monetary intermediation. Reduce dependence on the formal financial system to the extent possible. And most importantly, resist politically the elimination of cash and the imposition of CBDCs, recognizing that once these systems are fully implemented, they'll be nearly impossible to reverse. The likelihood of successfully resisting this transition is low because the forces pushing digital money are powerful and coordinated, while resistance is diffuse and politically weak. Most people don't understand the implications of digital money until it's too late, and even those who do understand face collective action problems where individual resistance is ineffective. But resistance is still important, both practically to delay implementation and morally to refuse complicity in systems designed for surveillance and control. Understanding how digital money will trap the middle class means recognizing that when all your money exists as database entries controlled by institutions that can monitor every transaction, restrict how you spend, and exclude you from the system entirely, you don't have money in any meaningful sense. You have permission to participate in economic life, permission that can be revoked silently and instantly without explanation or appeal. The surveillance is total, knowing everything you earn, spend, own, and owe. The control is absolute, able to prevent transactions, confiscate wealth, and enforce policies through the currency itself. And the exclusion risk is catastrophic because financial exclusion in a cashless society means inability to work, buy food, pay rent, or survive economically. The trap is being built now while being disguised as modernization and convenience. The 134 countries developing CBDCs aren't doing it for your benefit. They're doing it to ensure they maintain control over money and, through money, control over you. The elimination of cash isn't happening because cash is inefficient. It's happening because cash allows private transactions that governments and corporations can't monitor, and the programmable money being designed isn't for your convenience. It's so that governments can enforce policy automatically through the currency without needing your consent or even your awareness that you're being controlled. If this gave you a new perspective, hit subscribe. The digital prison is being built one convenient tap-to-pay transaction at a time. The 134 jurisdictions developing CBDCs, representing 98% of global GDP, are constructing infrastructure for total financial surveillance where every transaction is monitored, where spending can be restricted by code rather than law, where accounts can be frozen without recourse, and where financial privacy becomes impossible because cash no longer exists as an alternative. China's digital yuan already demonstrates the control. Government knows who spends, what is being spent on, and where it is spent, and can immediately freeze questionable assets or accounts. That same capability is being built into CBDC systems globally, disguised with promises of privacy protection that will evaporate the moment governments decide surveillance serves their interests. Your transaction history reveals everything about you: your health, politics, relationships, habits, and preferences. Data that's being shared or sold to advertisers, data brokers, and government agencies, while creating high-value targets for cybercriminals. And when cash is gone, when every transaction requires approval from systems that can deny instantly based on algorithms or politics or errors, financial exclusion becomes exile from economic life itself with no alternative and no appeal. The middle class will be trapped completely, dependent on systems they don't control, monitored constantly, restricted through programmable money that enforces policy automatically, and facing the constant threat that one misstep, one algorithmic flag, one political disfavor will cut them off from their money and their ability to survive economically. The trap is closing now. And once it closes, once cash is memory and all money is digital entries in databases you don't control, You'll discover that financial freedom was never about how much money you had, but about whether you actually owned it or just had permission to use it, until that permission was revoked by institutions that owe you nothing and answer to no one.